Gold just had its worst weekly percentage loss in over 40 years. Let that sit for a second. Not its worst week since the 2008 crisis. Not its worst week in a decade. 40 years. We are talking about a move that belongs in the same category as some of the ugliest moments in modern financial history. And here is what makes it strange. As of this week's close, spot gold is sitting near $4,494 per ounce. 6 weeks ago, it was above $5,500. That is not a blip. That is nearly $1,000 erased in under 2 months. The metal printed an all-time high in January, and now it is down almost 20% from that peak. But here is what I can't stop thinking about. Central banks are still buying. ETF holdings just hit a record. JPMorgan has a year-end target of $6,300. The structural case for gold, the one everyone has been citing for the last 2 years, has not changed by a single variable. So what actually happened? A secular bull market doesn't just fall apart in a week without a reason. And if the reason is temporary, that's a very different conversation than if something fundamental broke. One of those scenarios means the dip is noise. The other means the thesis is cracking. Let's figure out which one this is. The story this week started in the Middle East, and it moved fast. Escalation between the US, Israel, and Iran, threats to the Strait of Hormuz, oil prices spiking on supply fears, and markets suddenly repricing what higher for longer actually means when you add an energy shock on top of an already firm Fed. Within 48 hours, the dollar strengthened, real yields pushed higher, and leveraged funds sitting on long gold positions started getting margin calls. That last part is the piece most people miss. When a heavily positioned market gets hit by a macro shock, the selling is not just from people changing their view. It is from people who have no choice. Forced liquidation is mechanical. It does not care about central bank demand data or long-term structural deficits. It just sells. And it sells fast. And it sells a lot. And it drives prices further than fundamentals would ever justify, which is exactly what happened midweek. Then came the partial recovery into the weekend. Safe haven bids returned once the immediate panic softened. Gold clawed back some ground, but the weekly damage was already done. 2 numbers explain the short-term ceiling on gold right now. The 10-year TIPS yield sits at roughly 2.10%. That is a real yield, meaning the return on U.S. government debt after inflation. And the DXY dollar index is hovering near 100. When those 2 numbers are where they are, gold faces genuine headwinds. Not because the metal's long-term story changed, but because the environment around it shifted. Here is the honest question I want to put to you before we go further. If you owned gold midweek, when it was in free fall, when the news cycle was screaming about Middle East escalation and oil prices, when your position was down sharply, what would you have done? Most people would have felt the pull to sell. That instinct is worth examining because how you answer it tells you almost everything about whether gold belongs in your portfolio at all. So why were people paying above $5,000 in January in the first place? That did not come from nowhere. The bull case for gold rests on 4 things, not opinions, structural realities that are documented and measurable. First, central bank buying. In 2025, central banks purchased 863 tons of gold, a near record. For 2026, the World Gold Council projects purchases around 850 tons. China, Kazakhstan, India, Turkey, Indonesia, the Czech Republic, Serbia, all net buyers in the first 2 months of this year. Russia sold some, but the overall picture is clearly positive. The deeper point is this. Emerging market central banks are still nowhere near their target gold allocation as a share of total reserves. That means this is not a trend that peaks anytime soon. These buyers are not trading. They are accumulating. A bad week does not change a decade-long strategic shift. Second, ETF flows. Global physically backed gold ETFs just recorded their 9th consecutive month of net inflows. Holdings have reached a record 4,171 tons, a above $700 billion. This is not retail money chasing a momentum trade. This is institutional capital, pension funds, asset managers, sovereign wealth funds making a deliberate allocation decision. Some profit-taking appeared in March during the sell-off, but the year-to-date trend is unmistakably positive. Third, supply. Global mine production is projected to grow only modestly this year, to around 3,672 tons. No major new supply enters the market before 2028 at the earliest. The structural gap between the rate of demand growth and the rate of supply growth is real, and it does not close quickly. You cannot mine gold faster than the earth allows. Fourth, and this is the one I think people consistently underestimate, de-dollarization. BRICS nations are quietly reducing dollar dependence. Not loudly, not with dramatic announcements, but steadily and deliberately. Gold is the neutral reserve asset of choice when you want to move away from dollar-denominated instruments. This is a slow-moving force. But slow-moving forces, compounded over years, reshape markets. Now, here is a challenge I want to put directly to you. Most people who say they own gold for inflation protection have the framing slightly wrong. Inflation matters, but the central bank bid I just described would persist even if inflation fell significantly. The real driver is a structural shift in how global reserve assets are allocated. And that is a much larger and more durable force than any single CPI print. If you think of gold purely as an inflation hedge, you are working with an incomplete map. None of that means gold goes straight up. GDK those who tells you otherwise is GDK. Two headwinds deserve a direct look. Real yields first. The 10-year TIPS yield at 2.10% is moderately positive. It is not high enough to collapse gold demand. The historical relationship between real yields and GDK prices is real, but it is not mechanical. Gold held above $4,000 while real yields were rising for much of 2024. But positive real yields do attract capital to competing assets, and they limit the urgency of holding something that pays nothing. This is not a crisis-level headwind. It is a cap. The dollar is the second. DXY near 100 is a genuine short-term ceiling. When the dollar strengthens, as it did this week on the combination of safe haven flows and reduced Fed cut expectations, gold-denominated GDK gets expensive for everyone outside the United States. Demand softens at the margin. The mechanism is simple, and it is working right now. What would need to change for these headwinds to reverse? GDK things. Either inflation resurgence that erodes real yields, which nobody is forecasting but which an energy shock could accelerate, or a clear Fed pivot signal, which is not coming imminently given the current data, or a Middle East de-escalation that, paradoxically, GDK at a safe haven premium removes the acute risk that was dragging the dollar up and liquidity out of GDK. That is a counterintuitive scenario, but it is worth holding in mind. The headwinds GDK are real. They are also contingent. They require a specific set of conditions to persist, and those conditions are not guaranteed. 30-plus banks have published gold price targets for year-end 2026. The consensus clusters between $4,800 and $6,300. JPMorgan is at $6,300. Goldman Sachs at $5,400. Morgan Stanley has a base case of $4,600 and a bull case of $5,700. The range is wide. It is always wide because nobody knows. But the direction of the consensus is clear. The detail I find most striking is this. JPMorgan has simultaneously raised its long-term fair value estimate for gold to $4,500 per ounce. at a current spot price of roughly $4,494, you are essentially at what the largest bank in the United States considers the metal's equilibrium value. That is not a call to run, but it does reframe the conversation. You are not buying gold cheap right now. You are not paying a speculative bubble premium either. You are buying at a price that, by their own model, reflects what the asset is actually worth given current structural conditions. These targets are built on the same pillars I described earlier: central bank demand, ETF inflows, real yield models. The logic is the same. The number is just the output, which means if your view on the structural drivers changes, the target changes with it. Anchor to the logic, not the number. Targets get revised constantly. Frameworks hold longer. Forward-looking honesty means mapping outcomes to conditions, not predicting, but framing. Here are 3 scenarios stated plainly. Base case: gold trades in a roughly $4,800 to $5,800 range through 2026. Central banks and long-term investors treat any dip below $4,500 as a buying opportunity. Volatility continues. This week proved that, but the structural trend holds. The geopolitical situation neither resolves cleanly nor escalates into something systemically destabilizing. This is the most probable path. Bull case: either a geopolitical shock resets the safe haven premium at a structurally higher level, or an inflation surprise, driven partly by the current oil shock, forces real yields lower and reignites both retail and institutional demand. In this scenario, the $6,000 level becomes achievable. JPMorgan's $6,300 target stops looking aggressive. Bear case: rapid Middle East de-escalation, genuinely strong U.S. growth data, and multiple Fed rate cuts that paradoxically pressure gold by strengthening confidence in the dollar while removing the urgency of hedging. The $4,000 level is the key support to watch on the downside, but this scenario requires a simultaneous alignment of conditions: de-escalation plus growth plus cuts, that currently looks low probability given where oil prices and Fed rhetoric actually are. 3 variables will tell you in real time which scenario is developing: Middle East headlines, U.S. employment and inflation data, and where the DXY is moving. Watch those 3 things. They are the leading indicators for gold's next major directional move. Here is the question worth sitting with. Which of those 3 scenarios does your current portfolio positioning actually bet on? Not in the abstract, specifically with the actual allocation you have right now. Most people hold gold, or don't hold it, based on a feeling rather than a thesis. Framing it as a scenario bet forces an honest answer, and an honest answer is more useful than a comfortable one. Gold is a hedge, not a return engine. That distinction matters more than any price target. The 5 to 15% portfolio allocation that serious long-term investors, Dalio, Tudor Jones, and others, consistently cite is not an arbitrary range. It reflects gold's correlation profile. The metal does not move with equities in the ways that matter most. When equity markets face tail risks, currency crises, geopolitical ruptures, sovereign debt concerns, systemic banking stress, gold tends to hold or rise. That is the job. It is not to double your money in a year. It is to not collapse when everything else does. Vehicle matters. Physical gold gives you direct exposure but carries storage costs and liquidity constraints if you need to move quickly. ETFs like GLD replicate the physical price with institutional liquidity and minimal friction, the right tool for most investors. Quality miners offer leveraged exposure to the gold price, but they add operational risk, management risk, and jurisdiction risk on top. A miner in a politically unstable country is not the same bet as the metal itself, even if the correlation is high most of the time. The week we just lived through, the worst weekly drop in 40 years, was not a signal that the thesis broke. It was the cost of holding a hedge. Hedges are uncomfortable precisely when the conditions around them are most volatile. That is not a bug. That is how they work. An entry or an add-on made during this week's dip, if you have conviction in the structural drivers, is almost certainly a better position than one made in January at $5,500. But conviction requires a thesis, and a thesis requires understanding what you own and why. The worst weekly percentage drop in 4 decades happened this week, inside a secular bull market. By Friday's close, the structural case was identical to what it was on Monday morning. Same central bank demand, same ETF holdings, same supply constraints, same de-dollarization trend. The world did not change its view on gold. A macro shock created forced selling, and forced selling creates price moves that feel like verdicts but aren't. Volatility is not a bug in gold. It is the price of the hedge. The assets that protect you from extreme scenarios will themselves be volatile during extreme scenarios. If this week felt dramatic, that is the point. Stability is not what you are buying. One last thing, and I want to say it plainly. Nothing in this video is financial advice. This is analysis, my attempt to think clearly about what happened and why. Your situation, your risk tolerance, your time horizon, I don't know those. You do. Do your own research, talk to a financial advisor if that is right for you, and make your own decisions. That responsibility does not transfer. The long-term trend is higher. The short-term path will stay bumpy. Those two things are not in conflict.